You know, I've been in this game for over 7 decades now, and I've seen empires built on sand crumble in a single afternoon. I watched the dot-com bubble burst, the housing market collapse, and fortunes evaporate faster than morning dew in the Nebraska sun. But what keeps me up at night today isn't what happened yesterday. It's what most investors refuse to see coming tomorrow. Right now, millions of Americans are sitting on assets they believe are safe. They're counting on these investments for retirement, for their children's education, for their future. And they have absolutely no idea they're holding ticking time bombs. I'm not here to sugarcoat anything. Charlie and I didn't build Berkshire Hathaway by following the crowd or ignoring warning signs. We did it by looking at what everyone else ignored and having the courage to speak uncomfortable truths. Today, I'm going to tell you about specific assets that could lose 50%, 70%, even 90% of their value overnight. Not in some distant future, but potentially within the next 24 months. Some of you won't want to hear this. Some of you will think I'm being too pessimistic, but I'd rather you be angry with me today than broke tomorrow. Let me start with something fundamental that most people get wrong about investing. They confuse familiarity with safety. Just because you've owned something for years, just because your neighbors own it, just because some expert on television recommends it, none of that makes it safe. I learned this lesson the hard way back in the 1960s when I invested in a textile mill called Berkshire Hathaway. Everyone knew textiles. America had been making textiles for centuries. It felt safe, familiar, like buying a piece of American history. That investment nearly ruined me. The textile business was dying, and no amount of nostalgia or hard work could save it. Today, I see investors making that same mistake on a massive scale with 3 categories of assets, and unlike my textile mistake, which taught me a valuable lesson, these mistakes could devastate millions of people who can't afford to lose. The first danger: meme stocks and speculative darlings. You know, when I was young, speculation was confined to the racetrack and the back rooms of questionable establishments. Today, it's celebrated on social media and treated like investment genius. People are buying stocks not because they understand the underlying business, but because they saw a rocket emoji on Twitter or because everyone's talking about it. Here's what you need to understand. A stock's price can only stay disconnected from its underlying value for so long. It's like gravity. You might defy it temporarily, but eventually it catches up with you. I've seen companies trading at 100, 200, even 500 times their earnings, with no path to profitability, held up entirely by momentum and speculation. When these stocks crash, and they will crash, it won't be gradual. There won't be warning bells or news headlines giving you time to get out. One day, the music stops, the momentum reverses, and prices collapse 80% or 90% in a matter of days, sometimes hours. I've lived through the Nifty 50 bubble, the dot-com crash, and the 2008 financial crisis. Each time, people told me, this time is different. It never is. The fundamentals always matter. Always. The second danger: over-leveraged real estate. Now, let me talk about something that's supposed to be as solid as, well, a house. Real estate has destroyed more fortunes throughout history than perhaps any other asset class, despite its reputation for safety. The reason is simple: leverage. People buy real estate with 80% or 90% borrowed money, sometimes more. They calculate their returns based on everything going right: rents rising, property values increasing, interest rates staying low. But life doesn't work that way. I'm particularly concerned about commercial real estate right now. Office buildings in major cities are sitting 40% empty because of remote work. Strip malls are losing anchor tenants to online shopping. The math that worked when these properties were purchased no longer works. Here's the thing about leveraged real estate: When it goes bad fast. You miss a few rent payments, you can't cover your mortgage, the bank forecloses. That 20% you put down, gone, overnight. And it's not just commercial. I see residential investors buying properties with razor-thin cash flows, counting on appreciation to make the numbers work. They're paying 2020 pandemic prices with 2024 mortgage rates. That's a recipe for disaster. The third danger, cryptocurrency and digital assets. This is where I'm going to lose some of you, I know. You've heard about Bitcoin millionaires. You've seen the charts going up and to the right. You might even own some yourself. Let me be clear. I don't hate innovation. Berkshire has invested billions in technology companies when we understood the business and the value proposition. But cryptocurrency is different. It produces nothing. It generates no cash flow. Its entire value rests on the belief that someone else will pay you more for it tomorrow than you paid today. That's not investing. That's speculation. It's a greater fool theory, and throughout history, the greater fool theory has never ended well for the last person holding the bag. I've said before that if you offered me all the Bitcoin in the world for $25, I wouldn't take it. What would I do with it? Unlike a farm that produces corn or an apartment building that generates rent, Bitcoin just sits there. You have to hope someone else wants to buy it from you. Could Bitcoin go higher? Sure. Could it go to zero? Absolutely. And here's what concerns me most. Millions of people have money in crypto that they can't afford to lose. They're treating it like a retirement account or a college fund, when not if. But when the crypto market has its next major crash, people will lose life-changing amounts of money overnight. The common thread, what ties all these dangerous assets together? They're all priced for perfection in a world that's anything but perfect. They all require everything to go right and nothing to go wrong. They all depend on momentum, sentiment, and the kindness of the next buyer rather than fundamental value. I've lived long enough to know that Mr. Market is manic depressive. When he's euphoric, he'll pay ridiculous prices for anything. When he's depressed, he'll sell valuable assets for pennies. Right now, in these specific asset classes, Mr. Market is euphoric. He's not thinking clearly. He's paying prices that make no sense. And when reality sets in, when interest rates stay higher for longer, when recession comes, when liquidity dries up, these assets won't just decline gradually. They'll crash. They'll gap down. And most people won't be able to get out in time. You know, people always ask me, Warren, you've been predicting problems for years. Why should we listen now? And that's a fair question. I've been cautious for a long time, and markets have kept going up. But here's what most people don't understand about risk. It's not about being early. It's about being right when it matters. I once said that you only find out who's been swimming naked when the tide goes out. Well, the tide is going out right now, and a lot of people are about to be very embarrassed. The interest rate trap. Let me explain something that might seem boring but is absolutely critical. The relationship between interest rates and asset prices. For the last 15 years, we've lived in a world where money was essentially free. The Federal Reserve kept rates at zero or near zero. When you could borrow money for nothing, almost any investment looked good. People bought stocks yielding 2% because bonds were yielding 0.5%. They bought rental properties with 3% cash-on-cash returns because savings accounts paid nothing. They piled into speculative assets because the opportunity cost of holding cash was so high that even terrible investments looked attractive by comparison. But that world is gone. It ended, and it's not coming back anytime soon. When the 10-year Treasury is yielding 4% or 5%, suddenly that speculative stock trading at 50 times earnings doesn't look so attractive. That rental property with a 3% yield, you can get better returns in government bonds with zero risk. That cryptocurrency paying no yield at all, it has to compete with safe, guaranteed returns elsewhere. This is what I call the gravity of finance. For years, zero interest rates suspended normal gravity. Assets floated up regardless of their underlying value. Now gravity is back, and what goes up must come down. The liquidity illusion. Here's something that's going to shock a lot of investors. The assets they think they can sell quickly might become impossible to sell when they need to most. During good times, there are always buyers. You list a property, and you get offers. You want to sell a stock, and there's someone on the other side of the trade. But in a crisis, liquidity vanishes. I saw this in 2008. Markets that had been liquid for years suddenly froze. Prices didn't just fall, they fell because there were literally no bids. Today's markets have even less real liquidity than they did in 2008. You know why? Because so much trading is now algorithmic. It's computers trading with other computers based on momentum and technical indicators. When those algorithms all decide to sell at the same time, there's no one left to buy. I look at some of these cryptocurrency exchanges, and I see market caps of billions of dollars based on tiny amounts of actual trading volume. If everyone tried to sell at once, those billions would evaporate in minutes. The same is true for many small-cap stocks, thinly traded real estate investment trusts, and speculative assets of all kinds. Here's the truth. Your asset is only worth what someone will pay you for it when you need to sell it, not what the last trade was, not what some app tells you it's worth, what you can actually get in cash when you need it. And for millions of people holding these dangerous assets, that number is going to be a lot lower than they think. The debt time bomb. Now let me talk about something that connects all these dangerous assets. Debt. We're living in the most indebted society in human history. Government debt, corporate debt, consumer debt, it's all at record levels. When I bought my first stock in 1941, America's government debt was high because of the war effort, but household debt was low. People saved money. They paid cash. Credit was for emergencies, not lifestyle. Today, people are leveraged to the hilt. They've borrowed against their homes, maxed out their credit cards, taken out margin loans against their stock portfolios. And corporations? They've borrowed trillions to buy back their own stock at inflated prices instead of investing in their businesses. This debt works fine when asset prices are rising and interest rates are low. But we're in a different world now. Interest rates are higher, and they're staying higher. That adjustable rate mortgage that was affordable at 3%, it's crushing at 7%. That margin loan that made sense when stocks were soaring, it triggers a margin call when stocks fall. Here's what happens in a debt-fueled crash. It's not just prices falling, it's forced selling. People don't sell because they want to, they sell because they have to. The bank demands payment, the margin call comes, the mortgage is due. And when millions of people are forced to sell at the same time, prices don't just fall. They collapse. The confidence game. I've always said that it takes 20 years to build a reputation and 5 minutes to ruin it. The same is true for market confidence. These speculative assets are held together by nothing more than confidence and momentum. Everyone believes someone else will pay more tomorrow. Everyone assumes liquidity will always be there. Everyone thinks they'll be smart enough to get out before the crash. But confidence is fragile. It can shatter overnight on news that seems minor in retrospect. I've seen it happen over and over. One day, everything is fine. The next day, one bank fails, one major investor announces losses, one economic report comes in worse than expected, and suddenly, the confidence evaporates. The dot-com crash didn't happen because the internet stopped being important. The housing crash didn't happen because people stopped needing homes. These crashes happen because confidence broke, and once it breaks, the descent is rapid and brutal. The warning signs are flashing red. Look, I'm not a market timer. I've never tried to predict exactly when markets will crash. but I know how to read warning signs, and right now, they're everywhere. Corporate insider selling is at record levels. The smart money, the people who actually run these companies, are selling their shares as fast as they legally can. Margin debt is still elevated despite market volatility. Retail investors are still pouring money into the riskiest assets at exactly the wrong time, like they always do at market tops. Valuation metrics across speculative assets are in the stratosphere. The ratio of market cap to GDP, what I've called the best single measure of where valuations stand, is screaming danger. Corporate profit margins are at unsustainable levels and starting to compress. Credit spreads are widening, meaning the bond market is getting nervous, even if the stock market isn't. I learned from Ben Graham that the market is a voting machine in the short run, but a weighing machine in the long run. Right now, the voting machine is still running on euphoria and momentum in these speculative pockets. But the weighing machine is coming, and it's going to reveal that many of these assets weigh a lot less than people think.